Hi everybody, I'm back with chapter 9 videos, 2 short ones, and the great thing about chapters 9 and 11, the last 2 chapters in the semester, is they have short homework problems, small assignments. I do that on purpose because these are not difficult chapters. Chapter 8 wasn't either, but I think this is a great way to end. I like when things get easier, right? So I'm going to tell you a little bit about chapter 9, some of the important things in it. For the first portion of it, it's not that it's not an important topic, but I didn't give you any homework in the beginning from pages 483 to, 484, now I'm confused. Yes, 483 to 498. It talks about a couple of topics, mainly the type of accounts I call bad guys at my business, and that means people that don't pay you. What do you do about people that don't pay you? Well, there are some things you can do, but accounting-wise, we're going to talk about that briefly. If you're looking at slides, I'm on slide 11, 12, and 13. First thing I wanted to talk about was the controlling account, accounts receivable. This is on page 485. We've been talking about accounts receivable since chapter 1. These are your charge customers. What they highlighted in this chapter is we call the whole entire piece of accounts receivable with all of our customers the controlling account. And then each customer is a piece of it. We call that the subsidiary ledger, or the sub-ledger for short. They do have a little example of Smart Touch with the $15,000 account receivable with 2 accounts, accounts receivable Brown and accounts receivable Smith, that I kind of think of it as the pie is the accounts receivable and the pieces of the pie are the subsidiary ledger. And the sum of the pieces always have to equal the sum of accounts receivable. This is always going to be true. Okay? And there's a really easy example on page 485 that you can take a look at when you're reading. Just showing when these 2 customers pay on their bill, how you handle it. You can do it in a compound entry. It's pretty easy, so I won't spend a lot of time on it. What they do kind of go on and on about in the first half of the chapter, I would say, are uncollectible accounts. And from an accounting perspective, what you do with them. There are 2 methods to take care of uncollectible accounts, or bad guys that I call them. They're actually called bad debt expense. You can do a direct write-off, which is as the accounts don't pay you, you write them off. In other words, you would charge it to bad debt expense and credit their receivables. I have to say, I do it that way. It is reactive rather than proactive, but I'm a small business, and most small businesses do the direct write-off method. But if you kind of follow the rules of GAAP, generally accepted accounting principles that you see all through the book, for especially publicly traded companies or corporations or larger companies, you really should have an estimate of bad debts. This is called the allowance method. They're going to be using this allowance method to show you accounts receivable from here on in. And this is a proactive approach. In other words, based on history and current market conditions, you make a educated guess or an estimate of what you think out of your accounts receivable is going to be uncollectible. In other words, they're not going to pay you. And again, you can get pretty close. You look at what's happened in the last couple of years and what's the current, economic conditions in your business, and you can come up with a pretty good estimate. I do estimates in bad times, like recessionary times, and I usually use the aging of receivables way of doing it, which the older they are, the less likely you're going to collect them. And this goes on for quite a few pages. Excuse me. They talk about direct write-off. But what I really wanted to show you, that what you can take away from this section goes all the way up to, again, this shows the 3 methods. I'll get into that. Into 498 has a summary. The allowance method is the preferred method. You're going to see it in all accounting books that they want you to do it this way. And again, this is good for companies that have a large number of accounts receivable, a lot of subsidiary people in the ledger. It is a much more proactive approach. You make the estimate, and the estimate I wanted to show you for Smart Touch is on page 489. They're saying here that, I think it's for, oh, no, I'm not that far enough, I'm sorry. This is the part I thought really showed it the best, on page 489. Smart Touch had $4,400 worth of accounts receivable. And out of that, they estimated only $80 was going to be uncollectible. That's pretty good. Of course, it's a small balance. So they made an estimate at the end of their year, the end of their fiscal year, December 31st. They attributed it to bad debt expense. Notice you're expensing it in the same period that the sales happened. That's why GAAP loves it. It's the matching principle. Match your revenue to the expenses in the same period to get the right, correct net income. So it follows all the principles of accounting, which is why GAAP likes it so much, and they don't like the direct one. And we charge it to the allowance for bad debt. That's the credit. Okay, that allowance account is contra to accounts receivable, which what I mean by that is it increases on the credit side. So you can see the bad debt expense right in the middle of page 489 is debited for what they think is going to be uncollectible. The allowance account, which is contra to accounts receivable, is credited. You can see it posted to the T accounts, right? And that allowance account is going to be subtracted. If you turn the page on page 490, you can see the balance sheet, partial balance sheet. This is the way you're going to see accounts receivable presented now, with the less allowance for bad debts, and that's using the allowance method. And every time somebody doesn't pay you, you write against the estimate. And this is the last thing I'm going to say about this, I promise. If you look up on 491, I'm now up to slides 9, 26, and 7, if you're looking at your slides. We see in January, they already had somebody that they think isn't going to be able to pay, and it's clock, accounts receivable clock, so they're going to write against their $80 estimate. They're going to debit the allowance account for the $25 and credit accounts receivable. And if he comes back and pays later, that customer, you can always reinstate it and then collect the cash. It shows you accounts receivable, slide number 27, 927, with the net realizable value. That is the same either before and after you wrote them off. We had 4,400 minus 80 equals 4,320. Net realizable value just means what you expect to collect minus your estimate for bad debt. And then after the write-off, it's 4,375 minus 55. Remember, 80 minus 25, that's where the 55 comes from. So, this is a long section and kind of tedious. It goes on and on, but at the end, the summary sheet, again, the 3 methods are, just to give you a quick rundown, you can estimate on percentage of sales that you think are going to be uncollectible, the percentage of receivables you think that are going to be uncollectible, again, based on history and current conditions. The one I like best is the aging. You make an aging schedule, and the ones that are the oldest, that's going to be your highest percentage. And I think that one is the closest estimate. Of course, the percentage of sales is the easiest. I don't have you do any homework in this. This absolutely drive you crazy. It's not that bad once you get used to it, but I wanted to focus on what I thought was the main part of this chapter, and that's the notes. But there is a comparison of the methods on 498 with a summary sheet. Okay, so that's enough about that. The second part of our little video focuses on the notes. The notes start 499 to 504 because you can see it's a smaller section, and I do think it is the important part of Chapter 9, introducing you to what notes are. Notes are, it's a written legal promise to pay. If you've ever had a car loan or any type of a loan, you know you had to sign something to get it. If you went and get money from the bank, you had to sign something. That's called a promissory note. I promise to pay you at this particular point in time at this interest rate, okay? This is what this is. These loans in Chapter 9 are all short-term notes. In other words, they're due in 1 year or less. They're current asset. It's just like an accounts receivable, except it's due at a particular point in the future at an interest rate that's agreed upon, right? And interest happens, interest accrues. In this chapter, we're giving the notes and going to collect the money plus the interest. So we're making interest revenue. In the next chapter 11, our last chapter, we're going to be getting the notes. We're going to be taking loans, and we're going to pay it back with interest, and we're going to have interest expense. We're going to be on the opposite end, right? The taker of the money. There are some terms on page 499, promissory note. This can be a little confusing. They call the debtor, the person getting the money, the maker of the note. Don't know why. That's an odd term. The payee of the note, the creditor, is the person giving the note. So I think these terms can be confusing. But the debtor is the one owing the money. That's not us in this chapter. We are the creditor. We're owed the money. We're giving out the loans. So the main thing, a couple of things that go along with this, you need to know 3 things in order to do a note. I'm going to start writing a little bit, okay? You need to know the interest rate, and that'll be stated in the problem. You need to know when it matures, when it's due, which is called the maturity date. Also due date. When are the people or businesses going to pay you back? Okay? And you also need to know the maturity value. How much are you going to get? And the maturity value equals principal plus interest. The principal is the amount borrowed, plus whatever interest is going to happen in the time period of the loan. How do you figure this out? How do you figure out what the interest is? Well, there's something called, used for all loans, the simple interest formula. And the simple interest formula is very easy to do. Okay? It equals, for sure, I equals PRT. That stands for interest equals principal, the amount borrowed. R is the rate, and T is the time of the loan. Okay? So in every single one of these loans, we have to figure out what's the interest so we can know what the maturity value is going to be. The due date is pretty easy. That's a terrible DUE, isn't it? Sorry. It's pretty easy when it's a year. That's 1 full year or 12 months. It's easy when 6 months, 3 months, 9 months, 9 over 12, 3 over 12. It's a fraction of a year. What gets a little crazy is when it's days, because you have to literally count the days. Nobody likes to count days in a month, but you actually have to when you have a problem with days. There's a really good example in the book. It's on page 501, and this is a 180-day loan. So they give you a lot of days to count in this example. That's why I like it. And the loan was given out dated February 16th. You never count the day the loan is given, but you count every day after that. So we gotta count 180 days to see when this loan is due. So they show it right up at the top of 501. Let me see if I have in case you're looking at slides. Slides. I don't think it's on the slides. I'm looking in the neighborhood of 947 to 950, but I don't know. I think it is in the slides when I checked. But check it out, 47 to 50, maybe one of those. But if you have your book open, it's on page, or if you have an ebook, it's on page 501. So they show February 1st. There's 12 more days to count, okay? This is a tedious process. You add March, 31, you keep a running total. April has 30, of course you have to know how many days in a month. Up to 73 and so on. 31 in May, 30 in June, 31 in July, and we're up to 165 if you look at the cumulative total. That means we're up to 165, we only need 15 more days. So it's due on August, right? 15th. That's the due date. We need to know that. We need to know when we're going to get paid back. So if we were putting this in the simple interest formula, I don't think they give an interest rate on this one, but I'm going to make one up. Say we're putting it into the formula. Say this isn't a $1,000 loan. The principal. If only I could make a decent zero. This is P, principal, times the rate. I'm going to say the rate is 6%. Always change it to a decimal when you put it in the calculator. It's just so much easier. If it's 10%, put 0.10, 8%, 0.08. It's just so much easier. And the time, I'm putting it into this formula, the time is going to be 180 days. When you have days, 180, it's so hard to, all right, let me do this easier. 180 would be your numerator, the number of days, over 365. They use 365 for the days of a year. That's going to give you what I is, your interest. This part is not in the book. I came up, I rounded it. It's about 29 and change. I rounded it up to $30 interest. So this is the interest on this loan. They didn't even give a rate for this $1,000 loan. They were showing the days, but I wanted to show you how to answer these three questions. The interest rate is 6%. The due date is August 15th. And the maturity value, principal plus interest, would be $1,030. So on August 15th, the company's going to get back $130, $100 principal, and $30 interest. Okay. So again, I made up the rate because they didn't give a rate for this one. But just to kind of show you one that is in the book, down at the bottom of 501, that same page, they show you when the term of the note is stated in months. Sometimes it's days, sometimes it's months. We compute the interest based on 12 months in a year. So say this is a $2,000 note at 10% for 9 months. It's easier when you have months. You don't have to count the days. So this is right at the bottom. So we're going to get the interest, here's the principal, P, times the rate, 10%, 0.10. The time, I already forgot, 9 months. It's always the numerator, the number of months, just like when it's the number of days, that's the numerator. The denominator for months, 12 months in a year, 9 over 12, put it in the calculator all at once, it takes seconds. And the interest is $150. So in 6 months, 9 months, I can't read, 9 months you're going to collect, rate, time. Okay, you're going to collect $2,000 principal plus $150 interest, maturity value $2,150 MV. Okay. So this is the main part of your homework. Besides the ratio problem, I think there's 3 ratio problems in this chapter, which I don't spend time going over because the examples for Coles in the book are so good, they're easy to follow. But I wanted to show you a couple more things before we wrap this one up. Okay. Now I'm on 502 and 3, and it ends on 504, so we're close. There's 3 reasons you're going to see in the book that a company might give a note. Okay, we're going to see examples between these. I'm going to give you the page numbers. On 500, even before they did the days, they have an example of loaning to an employee for a year for $1,000. Okay. Sometimes a company will loan to an employee or another business. The second reason, which is on 503, is for a special sale. Instead of selling somebody something and making an accounts receivable for it, they're giving them a note for it. Might be a little more money to give them a little more time to pay, and also reap the benefits of the interest revenue. So this might be a special sale. We're going to see example of that on page 503. Also, in the next video, I'm going to do a short problem for you that has all 3 reasons. Okay? The third one is exchanging an accounts receivable existing for a note. In other words, you have a customer that's having trouble paying and they need more time. Well, you could offer them to grant them a note, an extension of time for a particular interest rate. That usually works well for people that can't pay. They like that. So that's a third reason. There's an example of that on page 503. So we're going to do, I'm not going to spend time going over it. You can check it out. We're going to do a problem very much like your lab problem. That's going to be a short notes receivable problem with all 3 reasons, okay, in it. Okay. The thing to watch out for is sometimes periods end and the interest gets split into 2 periods. So we'll have to watch out for that. And sometimes the people don't pay you back. This is on page 504. We call this a dishonored note. If you look on the bottom of 504, this is slide 64, 964. We had granted a note to Adair, A-D-A-I-R, and the time came for them to pay. It was a $1,200 note, and they gave it on March 3rd. And they defaulted or dishonored the note on September 3rd. So what do you do accounting-wise in that case? Well, you have no choice but to put it back into accounts receivable and credit the note because the note is done. But what to remember if somebody defaults on a note is you have to add the interest because the interest happened anyway. They owe it to you. So when you put it back into accounts receivable, make sure you add in the interest. And when you credit the note, it's just for the principal, but you have to actually put interest revenue because you earn the revenue even though you didn't collect any money. This looks just like the journal entry when you collect on the note, except you didn't get any money, right? You got no money. What you had to do was put it back into accounts receivable, and then hopefully the person will pay you down the road. What they usually do in this chapter is you write it off. You write it to bad debt expense and then the allowance account. So in the next problem that's coming right up, I am going to do problem 940B. That gives you all of this in a new example. So I'll see you in a couple of minutes, okay?